Yeah, congrats on the new position. I'm excited for you. Okay, we are now broadcasting live, so good morning. I will call the meeting of the Standing Committee on Government Operations to order. My name is Julian Morse. I'm the MLA for Frame Lake and the chair of the Standing Committee. This morning we have Duncan Baumfield, CEO, and Dr. Victoria Barbary, Director of Strategy Communications at the International Forum of Sovereign Wealth Funds, and they will provide a presentation on sovereign wealth fund governance to our committee. Today's meeting is public and being live streamed on the Assembly's social media channels, and we do have an in-person witness this morning. Before we begin, I would like to remind all members and witnesses to direct your comments to me as chair. It helps us run a smoother meeting, and it helps our audio and visual person in particular operate the mics and cameras. So please wait to be recognized before speaking. It just helps the meeting run a little bit more smoothly. And I'll now ask members to introduce themselves, starting with members in the room, and then we'll move online. So Ms. Reid.
Good morning. I am Emily Reid for Great Slave here in Yellowknife. Thank you.
Okay, and we'll go online, starting with Mr. Hawkins.
Good morning, everyone. Thank you very much. My name is Robert Hawkins. I'm the MLA for Yellowknife Centre, and as always, I'm happy to be here. Thank you. Just checking. Hi, can you hear me?
Yeah, we can hear you just fine. Mr. Rogers, you want to introduce yourself?
Good morning and Happy New Year, everyone. My name is Denny Rogers. I'm the MLA for Newbycote Lake.
Okay, thank you very much. And I'm now going to invite Dr. Barbary and Mr. Baumfield to please introduce yourselves and proceed with your presentation. Thank you very much.
Hello, I'm Duncan Baumfield, the Chief Executive of the International Forum of Sovereign Wealth Funds.
Hello, Happy New Year, and my name is Victoria Barbary, and I am the Director of Strategy Communications at the International Forum of Sovereign Wealth Funds.
So what I'm planning to do, if this is okay with the committee, is, we're planning to run through a brief presentation, 10 to 15 minutes, and then really open it up to questions any questions that you might want to ask. We'll be happy to share those. But also, if you want to question any part of the presentation, please do so. We're very happy to undertake that. And of course, we're very happy to have this as a document of record for the citizens and stakeholders. Just as a technicality, hopefully you have a copy of this presentation in front of you. Do you want us to share it on the screen or just to talk through it?
Thank you. I think it would be helpful to share it on the screen just because we do broadcast these.
Okay.
So that would be good. Thanks. Yeah. Excellent. Okay.
Okay, so there we go. So what I'm going to do, I'll start and then I'll hand over to Victoria. Let me quickly just introduce the International Forum of Sovereign Wealth Funds, or IFSWF. We trace our history back to about 2007, where for various reasons, primarily the US government being concerned about potential takeovers by foreign entities that were controlled by governments of important US companies, but also at the same time, the IMF being concerned about balances that in oil-rich countries that weren't on the central bank balance sheet. Basically, a collection of sovereign wealth funds got together and they defined the Santiago Principles, 24 principles of good governance about how sovereign wealth funds should practice and govern themselves in a way that would allow recipient countries to identify them as financial investors. And from that, the International Working Group was created, and a little bit later, that became the IFSWF. And originally, that was housed within the IMF in Washington for a number of years, until about the end of 2013, when it was decided that it should be independent. And at that stage, the organization established itself as an independent non-profit company in the City of London. And in part because that was closer to its members, but also because the UK has no sovereign wealth fund, so there's no danger of capture. And at that same time, the remit of the IFSWF expanded from beyond just that governance organisation, really to looking to help its members to deliver better returns, better risk-adjusted returns for their investment. And to do that primarily through sharing information and knowledge between themselves. Also, it took on a role really as representing all sovereign wealth funds, so collectively. And the way that we do that is through the publication of data and research. So we spend a lot of time researching into the activities of sovereign wealth funds, their investments, but also we do academic research into sovereign wealth funds as well. Most recently, together with the Fondo Reserva de Latin America, we put out a report about why there aren't more sovereign wealth funds in Latin America. So increasingly we do those kind of activities as well as the knowledge management and networking. We have both an online program for members, but also we host a number of events as well. So that's the history of IFSWF, and we've also expanded from that original membership that we now have 39 full members and 7 associate members, and you can see the dots around the world. It's very much a global organisation, and literally on every continent that you can see that. So we've got quite an extensive reach in terms of that. And as I've said, the reason that has grown is because of two things. I think both the value that we bring to our members through those networking and other activities, but also the maturity of the idea of sovereign wealth funds as a piece of public policy. As they become more established so think back to what I said about back in 2007, how people didn't really know what they were, to today where alongside public pensions, they're listed as one of the primary asset owners in the financial community and are regularly referenced by asset managers and others and invest right across the range of financial instruments that are available to commercial investors. So really it's very much matured sovereign wealth funds to be much more recognized by not just by the financial world, but more widely than that. And that's because there's been a certain amount of evolution of sovereign wealth funds. And Victoria, do you want to take the committee through that some of that evolution?
Yes, of course. Thank you, Duncan, for that. So I'm just going to do a few slides on a kind of general overview of sovereign wealth funds and kind of bringing it up to the present day. As Duncan says, there's been quite a lot of changes over the last few years since the Heritage Fund was formed. So this is the definition that we have in the Santiago Principles that was obviously written in 2008. And I think the most important thing is that these institutions are owned by the general government and that they are there to achieve financial objectives. And those are the two parts of that definition that we would highlight today that differentiates a sovereign wealth fund from a development bank or a pension fund, for example, or a central bank. Where we are now is that there are really 3 types of sovereign wealth fund that have developed over recent years. There's the kind of traditional savings fund that we would think of. So the funds out of the Arabian Gulf, for example, that come from natural resource revenues or foreign exchange diversification that you'd expect to come out of Asia. So we're thinking of Singapore and China and Korea. And then pension reserve funds, such as those in Australia and New Zealand, which, although they're put aside to defer for superannuation in the future, that will go into the general budget. So they still act as sovereign wealth funds. Then you've got stabilisation funds, which are which are there to intervene in the currency markets if for natural resource funds where if commodity spikes, then the currency becomes overvalued, they can intervene in the markets, or smoothing governments that are bending across the commodity cycle. And then we have a relatively newer group of funds that we call strategic investment funds. And these have a primarily domestic mandate. And as you can see on this slide, they can do a number of things. The traditional one is stewarding state-owned enterprises, but they can also, as I've got here, enhance local stock market liquidity, promote economic development by investing in strategic sectors, and increasingly importantly, attracting long-term FDI as a promoter or partner. And we've also seen the growth of funds that do a number of those things. So this is quite a useful chart that I use a lot, and it just gives a little bit of an overview of the history of sovereign wealth funds. And you can see that the first were founded in the 1950s, and these were primarily for managing natural resource revenues for intergenerational savings or stabilization. And you can see, I quite often show this chart with the oil price mapped on it as well. But there are notable spikes in formation of sovereign wealth funds around oil price spikes. So you can see that there were 3 formed in 1976. You've got the 2006 and the 2006 spike during that boom time before the global financial crisis. But since the GFC in kind of 2008-9, we've seen kind of 2 real trends, which I think this graph well demonstrates. The first is that the number of sovereign wealth funds is growing, and it is proliferating. And we're seeing, as you can see, over the last decade or so, that there are new vehicles established every year, and now we're up to about 100 globally. I think there were about 60 when I started looking at this group of investors about 15, 16 years ago. So it's really been a real growth time for them since about 2011. And then the other part of this trend in growing numbers of sovereign wealth funds is that we've seen, as I said, this new generation of strategic investment funds, and these were initially formed in Africa. But they're now across the world, and they tend to be much smaller in scale than traditional hydrocarbon funds. And I think that it's important to mention that a lot of these countries that have formed these strategic investment funds are often in states that are running fiscal deficits. I think there tends to be a understanding that really sovereign wealth funds are formed in countries with a fiscal surplus, and increasingly this kind of innovation of a strategic investment fund, that means that this is increasingly untrue. And so we're seeing this change in the nature of sovereign wealth funds, and that is also reflected in the makeup of our membership as well. So that's just something to bear in mind. So just to kind of finish this overview, I think there are 2 current themes that we really need to look at and think about when we think about sovereign wealth funds today. The first is that the rise of the hybrid mandate, and that's really been since the COVID pandemic. That sovereign wealth funds are being asked to take on additional and more visible roles in their domestic economies. And since the pressures on sovereign balance sheets that have emerged since 2020, the need to invest in the energy and transition, for example, and there are a whole load of spending needs, whether that is healthcare or development, it's really been harder to communicate and to sell the macroeconomic benefits of kind of traditional savings funds to citizens. And increasingly, either explicitly or implicitly, sovereign wealth funds have become much more active at home. And I think one of the most recent examples of this is the Future Fund in Australia, which has recently been tasked to support local priorities such as increasing the supply of residential housing, supporting the energy transition, as I mentioned before, and delivering improved infrastructure. So really, the Future Fund was already starting to invest in these sectors because it can invest. It's always been able to invest at home. But really, this has become much more explicit in the change of its mandate. I think that was in early December. And then we've also found that there are some development funds in developing economies that have had this domestic mandate, but they've become the kind of center of financial expertise in these countries, and they've been asked to take on a savings function. So if we look, for example, in Senegal, FONSIS, the sovereign wealth fund there, which was originally a development fund, has been tasked with managing the country's new oil and gas royalties for future generations. So we're seeing this rise of the hybrid mandate. So I think that's kind of an important thing to look at, and that is going on globally, whether it's kind of explicit or not, as I said earlier. And I think another trend that is very, very clear as I've traveled around the world the last couple of years is that we're seeing, even in regions that are traditionally considered quite opaque, increasing demands from stakeholders for greater transparency and accountability in the way that this wealth is managed. We're seeing even in the Arabian Gulf more information coming out about investments and strategy, and there is in countries that are forming sovereign wealth funds at the moment, and I've recently been to Mozambique, but also in Namibia, there's a much wider desire to engage civil society in thinking about the formation of those sovereign wealth funds. So I think that those are two really key themes to think about at the moment, and two that we're really thinking about. So, I mean, the Santiago Principles, as Duncan mentioned, are our founding tenet. They're globally accepted code of conduct and governance for sovereign wealth funds. And really, we've seen the use of these principles, and I'm not going to read through this slide, don't worry, because you've got it in front of you. But I think just to kind of summarize here, the reasons for adopting the Santiago Principles have kind of changed. Whereas this was initially a license to operate globally for our founding members, increasingly it's particularly with the rise of the domestic sovereign wealth fund, the Strategic Investment Fund, that it's a way of demonstrating to stakeholders that the institution implements global best practice, which helps with this accountability and transparency I was just talking about. And also is linked to the rise of the domestic fund who are looking to partner with global institutions, whether they be DFIs, whether they be banks. We're really seeing that these are a badge that says that this is a legitimate institution to partner with. So that is a kind of new theme that we're thinking. And they've also entered international law as a way of defining what a sovereign wealth fund is. So if you implement the Santiago Principles and you're an IFSFWF member, that helps you to say that we're a sovereign wealth fund. And I can never remember the correct amount of letters in it, but the new TPP, the CTPPP, actually has this written into law. So this is increasingly part of international organizations. And as a way of helping members with all of that, we now ask our members to do a self-assessment against the Santiago Principles. So in other words, explain how they implement the principles every 3 years. The Principle 24 asks for a regular review, and we've decided on that as being every 3 years. And those are all published on our website. So it enables everybody to benchmark themselves. And indeed, I've had a couple of conversations with people doing that this year. And 2025 is a Santiago Principle self-assessment year. So everybody will be doing a new one this year. So I'm just going to run you through this is the kind of top line if I was going to distill it down. And again, I'm not going to read through this slide because you have it. But there are kind of 4 real tenets of the Santiago Principles as outlined here. The management of the fund is qualified and it's independent. So it's free from political interference from the government owner, and that they have the capability to act in the best interest of the fund. Clear deposit and withdrawal rules, particularly for natural resources funds, is absolutely essential because it prevents money being taken out ad hoc. We've seen poor governance around this result in funds being wound down. So I think particularly Kiribati is the classic one, but also Venezuela, which was run down by Hugo Chavez's regime. Clear objectives is absolutely key. It helps ensure that what is it there for? It helps communicate to citizens what the purpose of it is. Return expectations are really important, whether that is how that is risk balanced. And then and this is a specific one in Principle 19, which is, are there any additional non-financial expectations or obligations that the fund has to take into consideration? So that might be ESG, it might be social value, it might be environmental. So there's things to think about there. And finally, the Santiago Principles have written into them, and even in 2008, that there are certain data points that need to be publicly reported and clearly publicly reported. This enables stakeholders to understand the fund, the mandate, that it's properly audited, and that there is external reporting that really enables all the stakeholders to understand what the fund is for. So that's kind of essential. So Duncan.
Yeah, sorry, Victor. I was just going to say, I thought this slide was especially relevant from our understanding of what the committee's review function is. But I just wanted to highlight that. I was also just conscious of time, and I know there's quite a lot of information, but it seemed to me that the two most crucial or probably elements we should just focus on in the last couple of minutes would be Pillar 3, and then just the reporting as well, because like so many things, these have evolved over years. So maybe should we just
skip through to Pillar 3? Yeah, I can definitely do that. Effectively, as Duncan said, the Santiago Principles are structured in 3 pillars. The first is the relationship to government. The second is the institutional framework and the government structure. But the bulk of the Santiago Principles are actually in Pillar 3, which are around investment and risk management frameworks. And I think that this is an important point to make, which is, that as you are moving through these different types of funds, you have increasing illiquidity in your portfolio and therefore increasing risk. And therefore, you need to have increased capacity. And I think that I actually wrote this slide a couple of years ago, but we've really had some conversations over the past 18 months or so, where we've spoken to savings funds, in several geographies, that haven't developed the internal capacity to invest in the assets, and instead they basically have a very small team either in a finance ministry or a central bank, and that they're relying on external managers or consultants to allocate the capital, and that's usually as a way of reducing management costs. And I know that this is a very live issue in North America in particular. But I mean, what we've noticed in the funds that we've been speaking to is that while this is a good way of starting a fund, our observation is that it's not really a viable long-term strategy, and it often appears to be a false economy, because the funds that have kind of decided to stay in this model have often underperformed their peers and therefore aren't really fulfilling their fiduciary duty to all their mandates to preserve wealth for future generations or for the current generation as well, or to save for a rainy day, because they're massively underperforming. And I think also another thing to point out is this situation can often lead to principal agent issues, where there's a misalignment of interest between the owner, which has a long-term investment horizon, and often with sovereign wealth funds it's decades long, and the manager that often has shorter term, maybe 5 to 10 year investment horizons. So I think that that's an important point to make, that actually increasing capacity, while it's more expensive, it can have benefits.
So I just noticed that Robert Hawkins has a question. Chair, would you like us to take that now?
No, I'll wait to the end.
Okay.
Thank you.
Duncan, do you want to take the disclosure and reporting piece?
Absolutely.
Just to finish off.
Yeah, just to finish off. Yeah, and I think this is increasingly what we've noticed. This is increasingly important in terms of the reporting element of this. And we've seen it. We've seen it. Transparency has grown right across the piece, and we see it, of course, with social media and the like. And it's become the expectation. And if we look at the journey of travel from our members, you will see that it's all been in this direction. So much so, and we have, for example, a number of members from the Gulf, which is perhaps a more traditional society in terms of the way that governments operate and in terms of media and things like that, compared to certainly the model we would have in the UK or in Canada. So, but today we roll forward, and of course these funds now have their own social media feeds. They have the likes of Twitter and Instagram and all of those kind of reportings. And increasingly, we're noticing that this is what the citizens of these countries are wanting. I should just say at this stage, there are some funds that aren't members of IFSWM, but they also undertake to report against the Santiago Principles as well. Now, the only proviso I'd put against that is, of course, as they're not members, the self-assessment and the comparison is really just against themselves. There's no fellow members to, in effect, act as critics and supervisors. However, the Santiago Principles have become those universal standards, I would say. But as I've said, there's really two elements in terms of public disclosure and reporting. Those have really increased over the years in terms of the amount of information that people now give out. And I was looking, for example, at the Heritage Fund, and I managed to find an annual report, which is all good in terms of the finance and the reporting of that, but there was no annual review and integrated report. So whilst you can see what the in terms of some detail on the investment of the balance sheet, there's no further detail beyond that. There's no breakdown of any climate impact of the investment. And all of those are increasingly becoming really part of the disclosure and reporting suite that sovereign wealth funds are increasingly turning to. So standards have undoubtedly evolved, and they've evolved to greater transparency and more disclosure. And as I say, that isn't just financial. It extends to the likes of carbon reporting and those kind of things. For example, we're currently just about putting together the latest iteration of our climate investment report, and that will be out this quarter. So, and that's typically what sovereign wealth funds are now reporting on. And crucially for that is because, as this slide illustrates, that not only leads to better decision making because there's more data and there's more transparency, it also gives a greater legitimacy. As the citizens of states and countries have more access to information, they become better educated in these things and generally more inquisitive. Now, in some cases, those numbers may be very small, but in some, there are very robust debates about the activities of the Sovereign Wealth Fund, its investments, and those kind of things. And we find that the better and the greater the transparency, the greater the engagement with its citizenship. It's not a straight line connection in terms of that, but as a general trend, that's what we're finding right across the piece. So it really is about building stakeholder trust, communicating who you are, but also so that your stakeholders can understand the risks and opportunities that you're set under. And again, setting some standards and some standards of leadership across the piece. So really, that's why that's become increasingly important. And let me just finish off with one final piece. And as I said, I went through your annual report and I looked at the return that you'd achieved and your investments. And it's just as a point of interest, around about a 3% return that it appeared to be that what the fund generated in the last reportable year. At that rate, it will take about 24 years for the fund to double in size. Now, and the best performer that we have, it would be either the New Zealand or the Australian fund that publishes its return data, I should add. Their return number is more like 10% over a number of years, which will allow their funds to double just over every 7 years. And so you can see a real difference going back to what Victoria said about building that expertise in terms of investment. Now, of course, those are very different funds, and it's perhaps unfair to make that comparison. I really make it just to show what is the art of the possible in these kind of things. But let me leave it there. We're now very open to really any questions that you have. And Chair, I'll leave it to you to sort of arrange the choreography of the questions.
Excellent. Thank you so much for the presentation, and indeed, we'll do that. And I believe we have Mr. Hawkins, who has indicated he wants to ask questions first. How we typically do this, just for the presenters, since you haven't presented to one of our committees before, is everyone gets a chance to ask a question and then a follow-up, and we cycle through committee and then go back to the top. So we'll start with Mr. Hawkins. Go ahead.
Thank you very much. Before I begin my question, it was breaking up a little bit. I couldn't hear the return question in the Northwest Territories. I think I heard Australian's version, and I heard something like a blip about 3, and then it went something about 24 years. Could you clarify that just before I get into my question? Because my question actually, oddly enough, is perfectly suited around that framework. So I just want to make sure I have the right number. Thank you.
And forgive me if I do you an injustice on this, but having gone through your annual report, it seemed to me that you had in the last reportable year, the fund had a return of approximately 3%, and at 3% annualized return, it takes 24 years for the fund to double in size. The very best performers over a significant period. That we know because they report the numbers, not everybody does, would be the Australian or New Zealand fund, which is closer to 10% in terms of annual return. And a 10% annual return will mean that the fund will double in size approximately every 7.25 years.
Thank you for that. I don't want to say perfect. The clarity was perfect. The reality is less than perfect. Okay, so that leads me into my area of questions. Thank you for reaffirming. I guess then, in essence, I did hear you correctly. I thought it couldn't have been that good. Okay, so my question really is around your pillar number 3, investment to the framework of risk and on into the return. I guess it's from your analysis of looking at what the Northwest Territories is currently doing. I'd like to eventually get into what you would recommend, but are we spending millions of dollars to make tens of dollars? And because I'm kind of questioning, is this an efficient process of what we're doing? Does it make sense, or are we creating a false economy within ourselves? In other words, we saved $1, the fund is working, but it's not really generating or producing anything. Not to mention, I think we have to borrow money to put money into it. So I think it's quite complex. Do you have any thoughts with respect to the overall process?
Well, the first thought I had actually was I couldn't find I couldn't find online, and it's not I didn't try that hard, but I couldn't find out what the mandate was or what your investment strategy was. So I can't comment on what you're trying to achieve, because I couldn't find any record of it. And as I say, it was only a cursory search. This is not anything more than that. But it just I couldn't tell you where you put your money, what external managers you used. I'm afraid I couldn't find any of that. So I'm really not qualified to say, I don't think. I just saw what was in the annual report. That was all I could find. And it seemed to me that it was in fixed income, government bonds.
Okay.
So just to add to that, and going back to the point that I made, I think that there is definitely from regardless of the scale of the fund, whether it's a small one or the large one, or a mega fund, developing some form of in-house capability to manage money is of benefit, and that's not just on a financial for it to improve returns, but also as a way of, and we see this around the world, as a way of developing skills and capabilities in the local economy as well. So having that financial skill in locally is often of benefit to the state. So I do think that it's that this model, and we've definitely had these conversations, as I said, where there's three guys who outsource to a external manager or several external managers and leave the money where it is in relatively low risk assets. Those funds have dramatically underperformed the market, and as I said, they're not really fulfilling their mandate by doing that. So that's just something to think about. And as Duncan says, we can't comment exactly, but that's just food for thought, I think.
Mm-hmm. Thank you for that. I guess. Sorry.
No, go ahead, Robert.
Okay. I thought someone said something. Okay, thank you for that. With what you were able to review, is it even worth the Northwest Territories continuing at this current time under its current model? I mean, really, the whole intent, and I'm in a unique position. I was there on the inception of the fund, the initiation of the fund, and then the initial application of the fund. But it appears it has gone almost nowhere and shown little return. The other aspect is, and our model, I don't know how unique it is, but I'll certainly say our model is we get money brought in through resource revenue. It's chopped up amongst our partners. That is a choice. And then the remaining money is done what it's done, and our partners are given the money unfettered. Now, that's fine. That's the agreement it came up with, and model it wants to work with. That's not the issue at hand. But in essence, though, is the territorial government receiving and investing, and maybe in some cases borrowing money that really isn't making any money? So in other words, from what you can see so far, should it even continue until it has a new model in place? Or do you see the current model, from what you could see, as doing something useful, or could be aligned better to do something useful? Thank you.
Well, again, it's very difficult because, as I say, it's, and this may be down to me just being inadequately prepared, but I couldn't see what it's quite hard to find any detail on the model. But the Chinese have a very nice phrase, which is, when asked, when is the best time to plant a tree? The answer is 20 years ago. So the fact is, you've done something far-sighted and establish a fund. So, and I think I should be congratulated for that in terms of trying to, manage those, the assets for the future. So I think that's a very positive thing. It's a question of what that mandate is, and whether you have the right investment strategy. So so I would applaud the Northwest Territories for its far-sightedness in terms of that. And clearly, you are generating a return. So, and I don't mean to be to denigrate that at all. But all I'm saying is, with, as Victoria said, with that pillar 3, is there are certain aspects that you'll have which perhaps you could find more beneficial. So typically in investing, if you don't need the income immediately, so there's you don't need the liquidity, you can invest for and receive what's known as an illiquidity premium. so you can lock it up. I mean, and any major institution will offer you a more beneficial rate for longer, only allowing long-term access. So it's a pretty well-established principle. So I don't think I'd throw the baby out with the bathwater in terms of this. In fact, quite the contrary.
And I think also that it's really about, and this is what I assume this process is all about, is reviewing it, is the fact that, as I mentioned right at the top, is that what we think of as a sovereign wealth fund and how they work and what they can do has evolved considerably over time. And certainly since your legislation was passed. And so what was best practice back in 2012 is probably not necessarily best practice now, which is what I assume that this process is all about, is working out how you can make it work better. So as Duncan says, it's not about saying that, oh, this is not working, we should scrap it. It's really about saying, well, how can we make it work better, given there's 12 years of knowledge and 12 years of evolution that have gone on over the last over that time, and adapting it. And I think that that's really important, is to say that there's lots of things you can do with it, and that's because there's been so much innovation over the past decade or so. So definitely, I agree with Duncan. It's not worth scrapping or throwing the baby out with the bathwater. It's going, how can we make this work better for citizens, given what we know now, rather than sticking with what worked in 2012.
Thank you for that. I have Mr. Rogers next for a round of questions.
Right, just let me unmute and get my pretty face up there. Awesome, thank you, and thank you, Mr. Chair, and thank you for the presentation. Certainly very informative, and we appreciate that. We've had some internal conversations around our fund, and our fund is relatively young. And I know when it was initially brought in, I think they've only in the last several years actually brought in a manager to oversee the funds. I guess my first question is, typically, like, what do you see in other sovereign wealth funds? Like, I know our fund is typically, we're looking at treasury bills, we're looking at bonds, we're looking at very, very low risk investments, very little in equities, very little in anything other than that tried and true. As you said, I mean, you can put it in a GIC for probably 3.5% or 4% now and leave it for a couple of years. So what do you see normally in other sovereign wealth funds with regards to how they kind of manage that risk? Thank you.
So do you want me to start, Duncan, and then I can hand on to you? So I think, there's with, I think, well, I like, when people say we're a young fund, I'm always like, well, how long is young? Because we've got members who started in 2018 and are now kind of fully fledged and would consider themselves fully fledged funds. So I think it's interesting. So, I mean, there's all sorts of ways. I mean, if you look at one of the mature funds, they are spread over, I think if you look at Mubadala out of Abu Dhabi, it invests across like 65 asset classes. And I'm not suggesting for a moment that you even go there, but you'll generally see, and this is to Duncan's point earlier, the savings funds and intergenerational funds will generally look to go for longer term investments with higher returns and harvest that illiquidity premium. So we would generally see a spread across debt, equity, real estate, and private equity, and potentially increasingly private debt as that asset class is maturing. And the reason for the private markets is that just if you lock up that capital, the risk-adjusted returns just tend to be higher if you're not needing access to that capital. But that does require liquidity management if you do have, with withdrawal rules that are going to require you that you've got liabilities at some point. But I think it's really about defining your risk appetite and your investment horizon. So is thinking about how you balance those two things. I mean, the other thing that we've seen, and this has only worked recently because of interest rates, is that if you look down in Guyana, which has one of the largest, well, probably the last massive oil find in a tiny country, so it's started a new sovereign wealth fund. It's just stuck its money in the Fed, earning 5.2%. That's all it's done. It's spent quite a lot of it on development, but of that revenue, but the money it's put away has just been sitting on account in the Fed at 5.2%, which is totally on the opposite scale. So it's not necessarily there's no hard and fast rule, but I would generally say that thinking about how much risk you're prepared to take on, how long your investment horizon is, it's kind of the where you need to start thinking about as you allocate across asset classes. And again, as I was talking about, experience, capability, capacity, and expertise.
I'd add to that in investment terms, there's a well-known principle about balancing risk. Actually, by having everything invested in fixed income, you're actually you are taking a greater risk than it would appear. The risk is not necessarily the risk of the capital itself diminishing; it's the risk of lost opportunity. But also, traditionally, one of the reasons why portfolios have both fixed income and equity is because the risk affecting one element of that actually has a positive effect on the other side. So you have a balanced portfolio to give you a more balanced risk profile. So do you see what I mean? So if equities were to be impacted, that would actually benefit the fixed income portion of the portfolio. So actually the overall risk level potentially comes down. So, and vice versa. I mean, if you'd invested, so for example, where we've had very low interest rates prior to sort of 2021, then over those years, that was to the great benefit of the equity markets. So you can clearly see that just as any one of us. And that's a fairly well-established principle. But I would suggest, and it depends on how much income you need from the fund. That's the other crucial thing on this. I don't know what income that you actually need, as opposed to, well, this is rainy day money that we don't need to impact. It seemed to me that, from what I could understand, that the principle had to remain intact. Therefore, if the principle had to remain intact, that was therefore illiquid. And you could certainly investigate widening that portfolio to take in other asset classes. And really, we only mean equities in terms of this. So, but anyway, let me leave it there.
Go ahead with the second question, if you'd like, Mr. Rogers.
Thank you. Yeah, I mean, we need as much as possible, I guess, is the answer. I guess typically when most people are investing, but I do understand, and I just noted in ours that it seemed like that the balance in our portfolio, and I know it's a conversation for another day and a conversation to have with whomever is managing our fund, but that our portfolio was a little, in my opinion, of course, was a little too risk adverse and a little too heavy on the fixed income than on the equity, and it's a conversation we're having. When you also look at other sovereign wealth funds, and I'm sure you give advice on setting up their investment strategy, do you also get into the weeds of discussing performance strategies and recommendations, and obviously how different funds are performing against indices and things like that? Do you go that far? And ethical investing, things like that. Is that something that you have conversations around?
No, we don't. Absolutely not. We're not qualified to do that. I mean, and under UK law, you have to be qualified. So I wouldn't be allowed to give you that kind of advice. But I wouldn't want to either. But I think that where we could get advice is the crucial thing is the mandate for the fund. What is the mandate that the fund is trying to achieve? And to be absolutely clear on that. And then that's the pinnacle of the governance from which everything else flows. So you have to be very clear on that mandate, and then you can have a target, a reasonably target for returns. So for example, is, it's a fund like New Zealand. Theirs is to take an appropriate level of risk. Now, that appropriate level of risk can be decided by its board, but and then there's various. Then they have various levels of governance within that. So, for example, when it was the global financial crisis and the assets, the value of assets dropped considerably in the equity market, they had a ceiling, a floor. So unless their whole portfolio lost over 20%, then that was just within the boundaries of acceptability. And of course, what they didn't do, that fund didn't sell when many others did, and it kept its portfolio and indeed even added to the equity, and it ended up producing the returns were much greater as a result. And you also saw that in sort of in the pandemic.
2020, yeah,
March
2020.
Where 2020, where a number of funds, the initial reaction looked to be the markets were tanking. They stayed the course, didn't sell at the bottom of the market, kept that, and of course, as a consequence, performed very well. But you have to have the governance in place, and that governance again stems from the initial mandate. That has got to be very clear what people are trying to achieve. And let me give you another example. The Future Fund in Australia, very successful fund in terms of its long-term savings fund, so much so that the government gives it other amounts of money to manage. So, for example, there's a healthcare fund and a housing fund. But those have different mandates. So its healthcare fund needs more liquidity. It needs more cash to come out. So theirs is a different balance of portfolio, and that doesn't produce higher returns as the overall savings fund, because it needs the money, and that's perfectly reasonable. That's only to be expected. So that mandate though is absolutely crucial.
Thank you.
Okay, thank you. I have Ms. Reed next for questions.
Thank you, Mr. Chair, and thank you so much to the presenters for their time and expertise today. My question is, I'm curious if there are any full or associate members of the IFSWF that have adjusted their approach from a underperforming fund to a more robust asset mix, so that committee might look at their trajectories and review them as examples that we could possibly follow. Thank you, Mr. Chair.
Oh, I'm just thinking, Victoria, who would we? I'm not sure I know.
Well, I think there are funds that have done so in relatively recent times, but I don't think we're allowed to name who they are, is the short answer to that question. So, I mean, I think a lot of this kind of move, as I was saying earlier, this is all about evolution. And you will find that what we see, and traditionally anyway, is that we've seen funds start off with a relatively conservative asset allocation and a relatively conservative asset mix. And as they mature and evolve and develop expertise, they move up the risk spectrum. And I think that, it's and as I said, as Einstein said, the definition of madness is doing the same thing over and over again and expecting a different result, right? So I think that there is this thing of having a trajectory of where you want to be in the future. And I think if you look over time this is probably a piece of work that I did about 10 years ago, which I should probably revisit. But there's definitely, because a lot of these funds are more mature now, but there's definitely a journey. I hate that word. Sorry, our former chair would shoot me for using that. There's definitely a trajectory of, as you develop, as you mature, to move up the risk curve to improve returns as you develop that expertise. And I think that any number, if you look at even the Abu Dhabi Investment Authority, it's over a long time, right? But it started in 1974. And over the past, I think it first started doing private markets in 1996. That might be, it was around that time. And then it had kind of first infrastructure was in 2006. And it's just gradually, as it's grown, it's gradually moved up and added more asset classes. So I think that's the general trajectory that we're looking for, rather than staying doing the same thing. So if you look at the the Petroleum Fund of Timor-Leste, they've had the same asset managers and the same asset mix for almost a decade, and that has dramatically underperformed because it's not had the ability from a capacity perspective to move up that trajectory. So I think that there's lots of, I'm sure there's academic papers written on this somewhere. But that's generally my observation of having been working in this world since 2007. So I don't have any specific examples to come to mind, but definitely, I think going back to my point, it's an evolution rather than sticking an institution in aspic and hoping that it will continue to perform. You've got to react to current economic and investment environments.
But and again, sounding like a broken record, I would say it has to be the appropriate level of risk. With the mandate and what is actually inherently or specifically written into that mandate. If the mandate is capital preservation above everything else, then that is very clear in terms of the mandate. If it is capital appreciation, then then there are some different courses that need to come as a result. But even before that, what is the fund for? What's the point of the fund? So, and that has to be built in, and it really all needs to flow from there in terms of that, because it's very clear that if it's that you can't go beyond that mandate, even if you think it's there's money left on the table, it has to be linked to the mandate and any founding legislation in your case.
Okay, thank you. Ms. Reid indicated she does not have a follow-up. I had a couple questions before going to the second round. My first one was just that I noted that Alaska is a member of your forum. And I was curious, I mean, I guess the Alaska Fund is probably organized as a state fund. And as you may or may not know, I mean, of course, our fund is just for our small territory. And I was curious, it seems to me that heritage funds for provinces or states or territories seem to be kind of less common than the sort of national sovereign funds. And I'm wondering kind of what your experience is with these smaller funds, and if you have any thoughts for us on kind of, I guess, if there's different ways that these are managed and how common they are, and what's typical for funds like this or different for funds such as ours from the national sovereign funds.
Want me to take that, or do you want to start with that one, Victoria?
So I would say, I'm going to be very brief on this. We have lots of subnational funds as members because Abu Dhabi has 3 sovereign wealth funds, 2 of which are members, and they're massive. But generally they are less common, and that's usually big, and they are often smaller, but that's usually because of the way that resource revenues or fiscal surpluses are divided up. What we do notice that if I look at Brazil, for example, it's a federal country that's never going to have a kind of national level sovereign wealth fund, even though it's very, very natural resource rich and it's got huge oil reserves. So it's been down to the states and the municipalities to set up their sovereign wealth funds. So because you're chopping up a big pie into smaller pieces, they are often smaller. But then if you look at somewhere like Malaysia, where the state of Sarawak is currently setting up a new oil fund, or has just set up a new oil fund, that they, as a state, they have a very much larger proportion of their oil revenues, and they're going to be quite large. But so there's not necessarily a correlation. It's really around how much of your natural resource revenues, or how much of whatever the revenue is that you're receiving. But honestly, if you've got a devolved government like you do in Northwestern Territories, it's pretty similar. I don't think that we think of them desperately differently, do we, Duncan?
Not from a principles point of view. The key difference is capacity and capability. Frankly, I mean, I don't know what size in terms of population the Northwest Territories is, but you're clearly limited in terms of how many people you have and therefore what you can do and get round to doing. But again, I will give you a parallel. One of our members is the island of Nauru. Nauru's got a population of about 2,000. It's got a fund of about $100 million, something like that. And they manage that through external managers. So, and I can think of the Marshall Islands and Micronesia as well, who have a similar type approach in what they do. And they, there's clearly going to be a different model for those, as opposed to, if we look at Alaska, and Alaska, their fund, the capability and the capacity of that fund in-house has grown over the years. And actually, I mean, I think they have about 70 or 80 people, and it's a real expert in terms of what it does. It's done some very innovative investing and things in spaces like private equity. Now, in part, that's because it can access a wider American expertise that's available to it, both in terms of external managers, but also attracting people to Alaska to itself to work for the fund. So that has evolved over the years in terms of that. So it's really, you have to get a model that's appropriate. You can't have if you've got a limited in terms of the size of the funds, it makes no sense to have to employ 100 people managing that fund. That just isn't, it makes no sense at all. So, I think common sense sort of dictates the approach that you take.
Thank you for that. The other question I had is just that, our Heritage Fund is one of the funds that is based on sort of non-renewable resource revenue or non-renewable resource extraction and the revenue that comes from it. And there's kind of an ongoing debate, and there was a debate at the time of the establishment of the fund as to kind of what to do with these resource revenues and what's the best use for them. There's kind of an argument that in a place like the Northwest Territories, which has quite a large infrastructure deficit, that the best use of resource revenues is to reinvest it in infrastructure. That'll help build up our economy, et cetera. And so I'm wondering, are there lessons learned or examples that we could draw from that would tell us sort of what the best mix of investment is? I realize that that's probably quite a nebulous question to get into, but it's an interesting one for me in terms of that is sort of the ongoing debate in the territory is, some people would argue, should we even have a heritage fund? We should be putting all of our resource revenues into infrastructure investment. So I'm curious, do we have examples of places where their heritage funds have performed well, or maybe even that revenues from the heritage fund have been used to invest in such infrastructure? Are there kind of best practices for what to do with non-renewable resource revenues that we could look to and draw from?
It's a very big subject. In terms of that, because there's in theory there's an approach that says, actually, are we better spending this money now, investing in the economy, and therefore by growing the economy will benefit all future citizens of the territory? So that's one argument. And that was the argument that we used in the UK when we discovered North Sea oil. So we share that with the Norwegians, and that was the UK decision. So the Norwegian fund is worth about just under $2 trillion. The UK fund would have been worth about $700 billion. But we don't have that. So instead it was invested in the economy. You then get an argument about was it spent wisely? But that's a different argument that we've got there. They're both valid arguments in terms of that. The principle about saving is that the extraction is at the time, but why should just one generation benefit? And the idea being from having a a non-renewable resource, you create a permanent financial resource. So that's as a principle. That's the argument for it, which I think is quite a powerful principle to benefit all generations, not just the current one. But in terms of then, I see what you're saying. You're saying actually, should you focus the investment policy actually on some domestic investment? So, for example, in infrastructure that the territories need, but you need to be careful with that because there's a tricky line there between investment and spending, and so you have to ask: is it going to generate a real return, a financial return? Even if it's of a benefit to society, does it generate a financial return? If it doesn't, then it's spending, and that's where you hit that difference. So it's certainly easier to have a fund and create a financial resource that pays a dividend to the government or the citizens, whoever it might be, and that they can then choose to spend that dividend.
Yeah.
And so that's the alternative approach that, frankly, I think is easier both to manage and to understand. But you could go the other way, but it is more complicated and more challenging to actually do successfully. So domestic investment is because of those political pressures on it is always a greater challenge. So I'm not sure I can point to anything specific to you there, but just to say that it's a very live debate in terms of that, and it still goes on today. So let me leave it there.
Yeah, and I think also just to add on to that, this is where you have the difference between, as Duncan said, investing for financial benefit at home, which is harder, and then having a liability that the government can use for infrastructure spending, for example. I have been talking to a couple of funds where we've been discussing that they want to do similar, what the government withdrawals is, and instead of having those just going into the general budget, is having them earmarked for specific types of spending. So having them put into, in your case, infrastructure spending, to make sure that money is properly spent. But that comes into the saving and spending rules rather than in the investment in the portfolio of the fund, which I think that's what Duncan was saying.
Okay, thank you. We do have time for a second round of questions. Do committee members have further questions for our presenters? Okay, I am not seeing further questions. I might, with the absence of further committee questions, ask one more of my own at least, and that is just, I wanted to put a bit of a lens on New Zealand and Australia. I noticed that Duncan, when he was speaking, kept kind of conflating the two. I think that New Zealand and Australia must have separate funds, and it sounds like both are very successful. I guess the question I would have is, what are they doing that is causing so much success? And I would ask that question in two ways. With their resource revenues, so are they both investing 100% of revenues into their funds? And the other question is what are they doing that's causing their funds to be so successful on the investment side?
Yes, and my apologies for I didn't mean to conflate them there. They would criticize me if they heard me putting them so close together. But it's just that there's a reasonable proximity. They're neighbours. They started at similar times as well. I mean, interestingly, Australia, which is very resource rich, that was created from the sale of one of its telecom companies, privatisation, and they used those funds to seed the future fund, as it's called. In both cases, they are pension reserve funds. And in both cases, there are no withdrawals from them. So there is no need for liquidity. So that's I would say, is fairly crucial. And then I would say the commonalities, they have different investment strategies, but both are very well governed. They have clear mandates and strong governance. And that has allowed them to put in place investment strategies that suit that mandate and work very well for that mandate. That's part of the reason I think they would argue for their success in terms of it. They have actually quite different approaches. The Future Fund uses external managers only. It doesn't have any in-house, doesn't manage any money actually in-house, whereas the New Zealand Super Fund does manage some things, such as on the New Zealand stock market, and New Zealand private markets will manage itself directly. So there are differences in their approach. But both are quite good models, I would suggest, in terms of just to look at, not least because they're very transparent in terms of information about them. So they're quite good to study. So in terms of that, so I think that's what I'd say in terms of that. And I'm sorry to repeat myself, but governance, both of those, has been absolutely crucial. Very clear mandate from the government, and then a strong governance framework that has been established and reinforced over time, so that they make the most of their unique attributes.
Yeah, and I think that's the one thing that is the same in both cases, as Duncan says, they actually manage their money quite separately, quite differently. But they both have what we call double arm's length governance structures, where the Parliament appoints a committee that then an independent committee, which then appoints the board, so that then appoints the management. So, and then the management is directly accountable back to Parliament every year. I think it's actually quarterly, or is it half annually? I can't remember. But I think that gives the management much more independence and that distance from government to be able to execute their strategies in, as Duncan was saying, in line with their mandate, and without having to reference back to the government, except they're accountable for their performance against what they're required to do. But that double arm's length governance structure is, I'd say, it is one of the reasons why both of those institutions are very successful, and they both share that.
Okay, thank you very much. I think you've made a very good case for the need for strong governance of these funds, so thank you for that. I'm just going to give committee one last chance if anyone has any burning questions. Any members online? Okay, I'm not seeing any hands go up. So with that, I would like to thank you both for taking the time to present to our committee today. Really appreciate it, or this evening from wherever you are. I think it seems like it's night there, but we really appreciate you taking the time, and I've certainly learned quite a bit here. So on behalf of committee, we wanted to thank you for your time, and thank you for presenting to us.
Well, thank you for inviting us. And just to extend as well, that we exist to help funds and establish themselves. So if you do need any help or assistance in the future, then please, we are very open to providing any help that we possibly can. So, and good luck with your review as well.
Yes.
Okay, thank you very much. And with that, this concludes the public portion of our meeting. So I'm just going to give staff a minute to shut down the public portion of the meeting, and if committee can stick around, maybe what we'll do is take a quick health break, and if committee wants to come back, we'll finish up our meeting starting at 10:30. So thank you very much again, Duncan and Victoria, for presenting to us, and we'll certainly be in touch if we have follow-up questions, and committee will be back, but that does end the public portion of the meeting. So thank you very much.